Alright, so in the previous video, we have already talked about the strong current earnings. That's the C in the CANSLIM. If you haven't already watched that, I suggest you to first go watch that video and then come back to this one. Because in this one, we are going to talk about the second letter in CANSLIM, which is the A. And the A out here stands for annual earnings increase. Now in the previous video, we had this first criteria, which was to look for strong quarterly earnings. And here's the truth. One good quarter doesn't prove anything. It could just be a fluke. To know if the company's growth is real and sustainable, you've got to zoom out and look at the annual earnings trend. Now, why do annuals earning matter? See, a true leader doesn't have just one lucky year. It shows steady rising earnings every year for at least last 3 years. That consistency is what separates these long-term winners from those one-hit wonders. If one of those years is down, then be cautious. A rebound only counts if it pushes the earnings to new highs, not just back to the old levels. Out here, you're looking for proof of durable, repeatable growth. So what counts as big annual growth? See, most of the best performing stocks in the history had annual EPS growth between 25% and 50% or more. The average early stage market leader grew around 35% to 40% a year before its big move. That kind of consistent ramp year after year after year is what you want to see. Something like this. Now, the currency can be anything. It can be British pound, dollars, yen, rupee, whatever. So it's going from 0.70 to 1.15 to 1.85 to 2.65 to 4.00. So this is not random. It's not haywire or cyclic. That's pretty much compounding in action. It's going one after the other after the other. It's like a ramp. So next, what you got to avoid is avoid the fake bounce back. Don't get tricked by rebounds from low base. If a company went from 6 to 3 to 4, that plus 33% might look impressive. But earnings are still below the previous high. That's a recovery. It's not real growth. Real strength means new highs in annual earnings, not just a comeback story. Now, the next point is the ROE and the cash flow, which are going to be the quality checks. Earnings alone don't tell the full story. If you also want to see how efficiently the company uses its money, that's where return on equity, the ROE, comes into the picture, which is the net income divided by the shareholders' equity. Great companies have ROE above 17%. And exceptional ones hit ROEs above 25% to 50%. And here's a pro tip according to the book, How to Make Money in Stocks. Check the cash flow per share. If it's 20% higher than the reported EPS, it means the profits are backed by real cash, not just accounting numbers. That's the kind of business you can actually trust. Now, the next one is the earnings stability, and that's going to be the hidden edge for you to see. See, consistency matters as much as the size. The best companies don't just grow, they grow smoothly. See, in the book, How to Make Money in Stocks, William O'Neils actually uses this. There's a rating system which he uses, the earnings stability rating, which is from 1 to 99. And out here, the lower the number, the steadier is the company. So when you plot several years of quarterly earnings on a logarithmic chart, the line should be nearly straight, steadily climbing with maybe a slight uptick in the recent quarters. And that is what real sustainable growth looks like. Now, the next one to see is market cycles and growth stocks. Remember, the market always moves in cycles. Most bull runs last 2 to 4 years before slowing down. In the early phases of a bull market, young, fast-growing companies usually lead. Turnaround or cyclical stocks, they tend to shine later, but they're riskier. If you buy a turnaround, make sure it's showing at least 5 to 10% of annual growth, plus 2 strong recent quarters that confirm the comeback. So how do you weed out the weak ones? Simply demanding 3 years of rising annual earnings filters out the weak ones. They filter out most of the weak stocks. Add strong recent quarters on the top and you're left with true leaders. But stay alert. Even great companies can slow down. If a firm that used to grow 30% a year now struggles to hit 10%, 15%, then it's acting like a mature business and it's probably not the next big winner. So the winning combo is the annual plus the quarterly earnings, the absolute best stock combined combines consistent multi-year annual growth and accelerated quarterly earnings. Both need to line up. One without the other equals a weaker setup. Another thing which the book says is not to fall in the PE ratio trap. Here's something which is gonna surprise a lot of investors. And this is not me saying it, this is the book. The PE ratio isn't that important as people think. It's not the cause of big moves. It's often the effect of them. Fast earnings growth pushes the PE higher, not the other way around. So don't automatically reject a high PE stock. Many legendary winners started expensive and got even more expensive as they ran. And what about a low PE? Sometimes that just means the market doesn't believe the story for good reason. Use PE as one data point, but not the deciding factor. Now here's a quick checklist before buying. The annual EPS growth should be up by 25 to 50% for at least 3 years. There should be a strong recent quarterly growth, accelerating, not a one-time pop. There should be a high ROE, ideally above 17%, best above 25%. There should be a solid cash flow, at least 20% higher than EPS. Look for earnings stability, low volatility, ideally under 25, and look for a high EPS rating. Ignore cheap PEs, focus on the best growth and stability. The bottom line is quarterly results tell you what's happening now, and annual earnings tell you whether that success was built to last. So when you're hunting for the next market leader, look for companies showing steady, accelerating annual earnings, strong ROE, and real cash-backed profits, not just one lucky quarter. That combination, quarterly strength plus multi-year consistency, is what turns the ordinary stocks into the next big winners. So I hope you guys like this one. We have finished the C, the A, and the next one is N. I'm just going to try to do that so I can use it for my thumbnail. I don't know how I did it. Okay. The N, which is the new products, new management, and new highs. So see you guys in the next one. Bye.